Edward Teather, senior economist Asean in India at UBS. He joins us right now from Singapore. Edward, hi, morning. Good to have you on the show. Firstly, a view that you're getting about the US right now in the run-up to all the expectations that, Fed is going to start interest rate hikes and further tightening is going to come in post-October. What's the sense that you are getting? Do you think the run that we are seeing in US equities could be challenged at some point?
Well, I'm not the equity strategist, but my colleagues in our economics team in the US for UBS do expect the tapering to come to a close in October, and I think that's very much in line with market expectations. The big question mark for markets is when does the Fed start to raise the federal funds target rate? Our view is that happens in June next year, and then the Fed funds target rate is lifted all the way to 1.25% by the end of the year. And we think that will have an impact on bond yields. We think US 10-year treasuries will get up to 3.25% at the end of this year, 4% at the end of next. So while I don't want to comment on equities, there's definitely going to be an impact on the market as a whole from those sort of moves, which I don't think are fully priced in yet.
Edward, everyone has a view on when the US Fed will start increasing interest rates, and everyone is of the view that that will be the big turning point for global economy and global liquidity. So what are your thoughts on when Fed actually will increase interest rates?
Well, it certainly is going to have an impact on the global economy and global liquidity. But let's remember, why the Fed is raising interest rates. They'll be raising rates because the US economy is doing a bit better, and certainly that will that process is going to affect those parts of the world that have been relying on US on the global liquidity being flush. But actually, the different parts of the world have different liquidity cycles. And interestingly, the question, of course, in India going forwards is when do interest rates start to come down, rather than will US policy rate hikes push interest rates up in India. So the liquidity environment does depend on where you are in the world.
India stands out in the world when it comes to inflation, and that is a problem area, and that some would argue will remain the big problem area. So considering that India stands out on the inflation front, how negative is that for Indian macros?
Well, that's the interesting point, isn't it? Because India has stood out over the last few years because it's had a higher inflation rate than elsewhere, and that's pushed up Indian bond yields relative to those in the US. US yields have fallen over the last 5 years. Indian bond yields have crept higher over the last 5 years. But now we're seeing very much a change in tone, we think, from Indian policymakers who are looking to tackle inflation. Mr. Rajan at the RBI has kept monetary policy tight, despite growth being a bit softer than expected in prior quarters. And from the government's perspective, they've moved aggressively to try and prevent monsoon-related pressures on agricultural supply from breaking through to much higher inflation. And ultimately, we think the work of the government and the RBI together will actually bring inflation down over the next 18 months, and that will create some space for lower interest rates.
So what's the sense that you're getting, Edward, about how the GDP in India could actually pan out? Because, off late one has had some upgrades coming in terms of what India's FY15 GDP is going to be, and some brokerages do believe that we could get back to those 6% levels as well. What's your own estimate?
Well, we tend to take a little bit more of a softer view on growth on average in FY15 and on average in FY16. We've penciled in, say, 5.3% this year and 5.5% next. So not arguing for growth to soar above 6%. Now, there may be the occasional quarter that makes it up there, but as a whole, we're not expecting the average to be that strong. Why not? Because we think the authorities are focused on getting inflation under control first, and that is a very important building block to getting a sustained acceleration in growth further down the line. There's that, and there's also the need for balance sheet repair in the economy as well. So we're not quite so positive on growth rapidly accelerating in the immediate future. We instead look for the building blocks to be built very solidly by getting inflation down first.
Edward, final question. 2-3 weeks ago, the geopolitical situation, be it Middle East, Ukraine or Russia, was slightly messy. For the moment, it appears that geopolitical concerns have subsided. What, to your mind, will be the impact of geopolitical problems on global growth per se?
Well, geopolitical problems are always potentially a worry. It is true that those concerns were heightened a few weeks ago, and they've come off a bit. There's always a risk they can come back again. You know, the underlying issues behind all of these things haven't really gone away. But I think it is interesting that markets weathered the storm or the geopolitical concerns pretty well over the last few weeks. And so long as things don't get too extreme, there's a good possibility that this will be more sort of noise rather than something that really changes the direction of the global economy and markets.